All right. So this week, I want to talk about financial ratios and how to use a stock screener. Granted, financial ratios might be a little bit of a big topic, so I want to take my time with it. If we don't finish, excuse me, if we are able, if going through financial ratios takes up the whole time, the whole hour or hour and a half today, we'll do the stock screener next week. I just feel like you know, you can't use a stock screener well if you don't have a good understanding of financial ratios. So with that being said, I am going to share my screen. And I don't have a presentation today, but I found a great, and I'll share this with you guys. Actually, let me print this. Let me make this a PDF. And all right. And then I'm going to share it in the Telegram, and then I'm going to get started. All right, so now you guys got that document in the Telegram, and we'll share it in the cohort folder, so no worries, it'll be there as well. All right, we can get into it. Financial ratios are ratios that are used to analyze the financial statements of the company to evaluate performance, and a number of things, right? There's 5 types of financial ratios. There's liquidity ratios, leverage ratios, efficiency and activity ratios, profitability ratios, and market value ratios. And before we get deeper into this, I actually just want to show you guys FinViz so you can kind of see why I'm saying what I'm saying, right? When we go to the stock screener, click all, you just click fundamental for now, right? Like, if you don't understand, what price to cash is, price to free cash flow, price to earnings growth, price to sales, if you don't understand what these things mean, right, you can't use this well. All right, so now let's just jump back over here. Actually, let's close out some of these tabs. Perfect. All right, so first one, liquidity ratios. Liquidity ratios measure the company's ability to meet current liabilities. This thing is a little messed up, but that's okay. This isn't my website. The liquidity ratio measures the company's ability to meet their current liabilities. And yeah, right. So when we're saying that is, does this company have enough cash on hand to pay if they were asked to pay all of their expenses or debts that were due within 90 days, right? So there's short-term debt and long-term debt, or let's just say short-term liabilities and long-term liabilities. So current liabilities are defined as liabilities that are due within 90 days, and then long-term is stuff that's due over or within a year or more. So the first one we have is the current ratio. So your current ratio is it might be because I'm in this mode that it's messing this thing up. Let's see. Okay, yeah, that's what it is. Yeah. Okay, so I'm going to keep it like this. So the first one is the current ratio, right? So your current ratio is your current assets divided by current liabilities. Under these types of ratios, a current ratio lower than 1 indicates that the company may not be able to meet its short-term obligations on time. A ratio higher than 1 means that the company has a surplus short-term assets. So for myself, let's just jump over here real quick. When I'm looking at current ratio, I'm usually looking at a current ratio of 2 or more. That means that for every dollar in current liabilities, once again, things that are due within 90 days or less than a year, they have $2 in cash. And then you might have companies that have, a current ratio of 4 or 5, and that means that that company is really cash rich. And that's sometimes, especially for like growing companies, if you're doing like, investing in tech companies, stuff like that, right? You really want to see a tech company that has cash or a growing company that has cash, right? Because if they don't have cash, what are they going to use to fuel their growth, right? You don't want a company that has to keep borrowing debt or using debt to fuel their growth. You really want them to be able to generate cash from their operations that they can go back and reinvest into the business. Does that make sense conceptually?
Yeah.
Yes.
Yeah.
Yes.
Cool. Perfect. So now we have what they call the acid test and the quick ratio, right? And now this determines, this is also another ratio that determines a company's ability to meet short-term liabilities with quick assets. So quick assets are your current assets minus inventories. So let's just actually get a nice definition for what current assets are. Let's go Investopedia. I just want to find a formula for it. All right, so the components of current assets are accounts receivable, inventory, prepaid expenses, right? So in the quick assets, the quick ratio definition, right? They remove inventory just because that's really not just a view of, the cash you have on hand and the money that you're having coming in with, that's less than 90 days, that you're getting in within 90 days. Inventory is your product, right? So once again, right, we talk about things being inflated, right? When you're looking at the current ratio, if you include inventory, a company could have let's just say they have $1 million in cash and $2 million in inventory, right? Like now they have $3 million in current assets, but that's not a real look at how much cash they have to pay off liabilities, right? Because you can't pay off, you can't pay your bills with products, so that's why they also have this quick ratio that removes inventories from the formula. They take current assets, they minus the inventories, and now they divide it by current liabilities. What do you call it? Yeah, so they actually say it right here, right? So quick assets exclude inventory and other current assets which are not readily convertible into cash. So once again, right, if it's higher than 1, then the company has surplus cash. But if it's lower than 1, that means the company relies heavily on inventory to meet its obligations. So now you might have a company so these are some good examples, right? You have Nestle, you have Hershey. These are the kind of companies that have tons of inventory. If you're dependent on if you're too dependent on moving product to pay your expenses, you might find yourself in a place where if there's a slowdown in the economy, if there's a slowdown in your industry, a slowdown in your business, or whatever the case might be, and you can't move your product, now you literally can't pay your bills. So that's something that's important to know. Depending on the kind of business you're investing in, the quick ratio might be very important to look at. Or even comparing the quick ratio to the current ratio, just to give you a real feel for what the company has going on. Now you have the cash ratio. The cash ratio determines a company's ability to meet short-term liabilities with cash and cash equivalents. So cash equivalents means things that you could quickly turn into cash. So let's just say, have you guys ever heard of a money market account? A money market account is maybe almost, I should not call it a CD. A money market account is pretty much when corporations have excess cash that they just want to earn a little bit of money on, they go and put it into the money market. So the money market, they're pretty much lending their cash to other companies for 30 days, a couple weeks, maybe 6 months. And then whenever they want their cash back, they could call it back in, right? So just a way to get a little bit of a return on your cash while it's sitting there, rather than collecting nothing. You could lend it to another company that they're going to pay you back right away. So yeah, just to go back to this definition, the cash ratio determines a company's ability to meet short-term liabilities with cash and cash equivalents. Now you have the operating cash flow ratio. Now that determines a company's that determines the times a company can meet current liabilities with operating cash generated. So we talked about from the cash flow statement, how you have your operating cash flow. Do you guys remember that from last week? So that's kind of what they're talking about, right? You go and take that operating cash flow and you divide that by current liabilities. And remember, right, the operating cash flow really gives you a real look at, is this company generating cash flow, pure cash flow from its operation? And that's a very important thing to know. So then they're just saying hey, can their operation cover its current liabilities? Now, the other type of financial ratio are leverage ratios. Under these type of ratios, it's how much a company depends on its borrowing for its operations. Hence, it's important for bankers and investors who wish to invest in the company. A high leverage ratio increases the company's exposure to risk and company downturns, but it also comes with the potential for higher returns. Right. So one of the first ratios in this, actually, before we, do you guys understand this concept though? Right now with the leverage ratios, what they're saying is, what are these people saying again? They're kind of saying, right, does this company need to, like I was saying before, borrow debt to run its operation, and are they dependent on also raising money from investors, right? Which is very real for it, because a lot of you guys are investing in tech. You'll see that, right? There's some tech companies that, you know, they might be doing some sales. Actually, they might be doing no sales, right? Let's take a company like do you guys remember was it Nikola? Yeah, the company was called Nikola. You guys remember that company, Nikola?
Yep.
Oh yeah,
Right. That was
drop to the bottom.
yeah, that was a company with no sales at all. They had a multi-billion-dollar market cap, and they were really just dependent on financing their operation through raising capital through investors, you know? And that's a real thing, and you got to be aware of that, right? When you guys are investing in these tech companies, you know, are they dependent on debt? Are they dependent on raising money from investors, right? They can't, if a company like that, right, if they can't get to that next funding round, then the company completely collapses, and you don't want to be investing in a company like that. So that's the point of leverage ratios. It really gives you a good look at, you know, what this company has going on or what they are dependent on.
Hey Jeff.
Mm-hmm.
So if we would have known this stuff, you know, beforehand, before Nikola, we would have been able to see this stuff coming with Nikola.
Absolutely. I mean, I remember myself telling people that Nikola was no good because they have no sales, but you know, sometimes nobody listens to me. So but yeah, but also for me personally, you know, I'm in tech, and so I see this firsthand, not even at the publicly traded level, but just like, you know, there's tons of tech startups that are out there that, you know, they're just going around selling a big idea, a big vision with no product, no sales, and investors keep giving them money, you know. And I even want to say that these venture capitalists and these private equity guys, as much as we're kind of like conditioned to think that they're the smartest guys in the room, right? You have people that's cutting billion-dollar checks to Nikola. Just to put that in perspective. So yeah, if you guys didn't know this, I think you guys probably would have avoided Nikola.
They had no product either, right?
They had no product.
Yeah, they didn't make a car yet, as far.
Yeah. I think they had technology though that they were working on, and that seems promising. And I think that's okay, right? But you know, the way that, and let's pull up their chart actually, just so we could, you know, bring the concept all the way. Why am I typing in FinViz? MKLA. Yeah. So like you see this, oh my God. I remember I had one of my friends though, he actually rode this, but he also rode it all the way to the bottom. He really believed in Nikola. And I used to tell him, like, the company does no sales. Like, you know, like yeah, see, like even right now, they're like almost a $4 billion company at $10, right? So that means at $90, that's 4 times 9. What is it? That 36? Like, you know, like it's a $36 billion company with no sales. Literally, even till today, sales is 0.0 million.
I know some people made a lot on some put options on that for sure.
Absolutely. So yeah. All right, so the first one we have is the debt ratio. The debt ratio helps to determine the proportion of borrowing in a company's capital. It indicates how much assets are financed by debt. So literally, it's total debt divided by total assets. If the ratio is low, it indicates the company is in a better position as it's able to meet its requirements out of its own funds. Higher ratio means there's higher risk with the company. We are in a time right now where we have rising interest rates. That's another thing to be aware of, right? Companies with too much debt or a high debt ratio they're going to have problems in times of rising interest rates because borrowing money becomes more expensive. So keep that in mind as well. And I'm sure you guys are still looking for companies and researching companies. So as we're entering this high interest rate environment, right? Well, we're not in a high interest rate environment, but we are in a rising interest rate environment. And as interest rates are rising, money's going to become more expensive, and companies that are dependent on debt, they're going to have issues, and their stock price is going to be impacted by that. So yeah, the debt to equity ratio. Now we have the debt to equity ratio. The debt to equity ratio measures the relation between total liabilities and total equity. So if you guys remember from the last session, equity is assets minus liabilities, right? You take all the assets that a company has minus all the liabilities and debt that the company has. Now you have what is left over for shareholders, and that's called the shareholder equity, right? And so this is why this is important, right? You're looking at, how much debt the company has to how much equity the company has. And once again, right, if the ratio is high, that means there is little chance that the lenders may finance the company. But if the ratio is low, then the company can resort to external creditors for expansion. What does this mean, right? Sometimes companies, once again, this dependence on debt, etc., right? If a company has too high of debt, that means borrowing debt is going to become more expensive for them. And if they can't continue to renew their debt and restructure their debt, then that company is really going to fall into issues. So that's another one that's important just to be looking out for, the debt to equity ratio. Now you have the interest coverage ratio. And this, right, the types of the interest coverage ratio, let's go down here. They don't have a definition for it, but it's kind of in the definition, right? The interest coverage ratio kind of just tells you, does this company generate enough income to cover the interest charges that they have to pay, right? Like let's just say a company is doing $20 million a year in profits, because this is looking at income. And now this is like crazy, but let's just say they have $30 million in interest expense, or let's just say they have, let's say they have to pay $2 million a month in interest expense, or just an interest from the debt that they borrowed, right? So 2 times 12 will be 24. So if they do $20 million in profits, but they got to pay $2 million a month in interest, right? The interest is going to eat up all their profits. That's just another thing to know. And that's if you guys are researching companies that have debt. These are very important ratios to know. You'll probably never really see that, though, that a company has more interest than their income. But you might see that, 30% of their income is going to paying interest, or 50% of their income is going to paying interest, right? And that's really not a good look, because if they're paying all that money towards interest, then they're not hiring employees, they're not investing in research and development, they're not using money to expand their operation. They're using their money to pay down debt, and that does not lead to growth.
What's the ideal rate in that situation? Like less than 10%, or?
That's a good question, and I think I don't think there's any ideal rate. I think what you really want to look at is, what is the industry average, right? For example, a technology company typically almost has no debt, but you might look at a car company. Like, car companies need tons of debt, right? Or maybe like a real estate company, like a real estate developer, right? Like, they're completely dependent on debt. So different industries have different industry averages. So I would more so base that on the industry average. And then what you really want to say is, does this company have a lower interest coverage ratio than the industry average? Actually, for all these things, you really want to be looking at what's the industry average. And even if you could get your hands on that kind of data, the historical industry average, right? Because sometimes we could just be in a moment in time where like the industry average at this current moment in time is way higher than the historical industry average, right? And that just might, so something might look like, hey, it's better than the industry average, but actually, even though it's better than the industry average, it's still not good. Does that kind of make sense, what I'm saying?
Yes.
Okay. Yeah. So I just want to say all these things are relative, and I like to just use the industry average as the base rather than saying like, you know, there's a specific percentage. So yeah. Now you have the debt service coverage ratio. Now this shows the number of times a company's operating income can cover its debt obligations. And I think that's, you know, that's pretty straightforward. Last week we talked about income from operation. Well, we talked about the different levels of profitability, right? You have your gross revenue, you have your you have your gross income, right? You have your revenue minus the cost of goods sold. That gives you your gross income and your gross margins. Then you have your operating expenses. So you have your revenue minus cost of goods sold minus operating expenses. Now that gives you your income from operations, right? So now this debt service coverage ratio, once again, is looking at that level. And then when you talk about paying taxes, interest, depreciation, and amortization, then you get your actual net income, right? But so this one isn't looking at net income, they're looking at the income from operation, right? Can the income that's generated from this operation cover the debt? And you want to be able to see that the answer is yes to that. Now there's a third type of financial ratios that's called efficiency and activity ratios. These type of financial ratios show the efficiency with which a company utilizes its assets. So inventory turnover ratio. This shows how efficiently the company sells goods. It just shows how efficiently the company sells its goods. Right, so now you have your cost of goods sold divided by inventory. A higher ratio indicates that the company is able to convert inventory to sales quickly. A low inventory turnover ratio indicates that the company is carrying obsolete items. I wouldn't say obsolete items. I guess you could look at it like that, but maybe we could just say that a lower inventory ratio means that the company has a harder time selling their goods for whatever reasons. Now you have the accounts receivable turnover ratio. We have a question in here. Yes, that's a good question. Is there a place to check out industry averages? There is. I don't know the website off the top of my head, but we're gonna look it up. Let's just say PE industry average. Oh no, let's not do that. Technology industry PE. Oh yes, the CSI market is a place to get the average for the different ratios. You kind of come here, you could pick whatever. They have the overall sectors, and then they have the industries within each sector. So like you could click semiconductors. Thank you for asking that question, Raz. This was a great question. All right, and then now so now we're getting like, right, I clicked the category of growth rates, right? So you have the year-over-year revenue quarterly growth. On average, the semiconductor industry is growing at 34%. Let's maybe look at profitability. All right, on average, the semiconductor industry has a gross margin of 45%. On average, the industry has a net margin of 28%. They have an operating margin of 32%. So this is a good place to just come and find the industry averages. So I'm going to put this in the chat. So now you guys have that link. I'll also put it in the Zoom chat. That's maybe a little easier for you guys. So this is a place to come and find industry averages. Okay, accounts receivable turnover. So yeah, accounts receivable turnover determines the efficiency of a company in collecting cash out of credit sales made during the year. Accounts receivable turnover ratio is credit sales divided by accounts receivable. A higher ratio indicates higher collections, while a lower ratio indicates a lower collection of cash. So what does this mean? So accounts receivable, I think you have to understand what accounts receivable is. Accounts receivable is, let's say, all right, let's say I'm a web developer, which I am, right? And let's, I might do a project. Let's say I say to Vanessa, I'm going to do your website for $2,000, right? But all you have to do is make a $500 deposit. And or let's say you have to make a $1,000 deposit, and then once I am done with your website and you're satisfied with it, you pay the remaining balance, right? So I would have gotten $1,000 in sales, but then there's another $1,000 in accounts receivable. And pretty much accounts receivable is money that is owed to you that you will receive once you complete the sale of a good or providing a service. Does that make sense? Just the concept of accounts receivable, right? You got to provide somebody with a service. You guys agree to providing the service and they agree to paying you, but they haven't paid you yet because you haven't completed the project or you haven't delivered the product. And that's what accounts receivable is.
Yeah, that makes sense.
Okay, cool, perfect. Total assets turnover ratio. This type of financial ratio indicates how quickly total assets of a company can generate sales. So you're doing net sales divided by total assets. A higher asset turnover ratio indicates they use a machinery, but indicates the assets used is efficient, and a lower ratio means the assets are inefficient. They're making the assumption that it's old and not able to generate sales quickly, but I wouldn't say it's old, but it does mean that they're not able to generate sales quickly, right? Your assets are your equipment, your human capital, your real estate, your office space, all these things, the machinery you have, like, if you're a pizzeria, right, you have to have this big oven or whatever, right? So you invested your money into all these assets that should be helping you generate revenue. And you want to know, like, hey, are these assets this company is investing in actually leading to sales growth? And this is a way to dictate that. Profitability ratios, right? So now this is used to determine the success of a company. The higher the profitability ratio, that means the higher the profits are for the company in comparison to other companies with lower profitability ratios. Yes, margin is more important than the value in absolute terms. For example, consider a company with a profit of $1 million, but the margin is just 1%. Then a slight increase in cost might result in a loss. Let's just get the definition of margin for you guys. I know what it is in my brain, but I want to get you guys, just so you guys understand what it is. Margin. Let's say accounting. I feel like I'm not finding a nice definition here. Let's just say, let's just go back to these people's example, right? You could have two companies, right? Once again, you can have two companies that are doing let's say $30 billion in profits, right? But if one company's profit margin is 30% and another company's profit margin is 5%, just like they said here, right? Any increase in cost, that company has a fight, even though they both have similar or the same total dollar amounts, right? The company with a 30% profit margin, if let's say that just the cost of raw materials for making their product goes up, right? They can eat that more so than the company that only has like a 5% profit margin, even though they both have the same amount of total profit. Does that make sense? And if it doesn't, I could explain further.
Yeah, go ahead and explain a little further.
Yeah. Okay, let's see if they let's come into here. I'm trying to think of a good example. All right. Help me here, Alex. What about what I just said maybe isn't all the way clear?
Oh no, I understand. I just wanted to hear if you what else you had to say.
Okay. Yeah, I'm trying to think of a better way to explain this. But yeah, let's say you are looking at two semiconductor companies, right? Semiconductors, like once again, right? Depending on how they run their business, right? They both might do like, let's say they both do like $30 million in sales or whatever the case might be. But let's say one company, their expenses come out to be, let's say, $5 billion, right? So that's $25 billion in profit, right? And then you have another company, and that's what I'm kind of not focusing on profit margin, but like gross profit margin. But another company, they have what you call it, $10 billion in expenses, right? So someone might look at them and say, oh wow, they both have they both do $30 billion in sales, and let's maybe just assume that they both grew at 100% for the year in terms of sales. So maybe last year they both did 15 billion. This year they both did 30 billion, right? But one company has way more expenses than the other, right? When you're doing these like profit margin ratios, it really gives you an insight more so into the level of profitability as opposed to like the whole number, because the whole number could just be a little misleading if you're not factoring like the expenses and stuff like that, if that makes sense.
It does for me. Makes sense.
Okay. All right. Is there anybody that it doesn't make sense for? I think this is a very important thing, because we're going to be looking at gross profit margin and operating margin a lot. Okay, I think you guys get it, so I don't gotta beat a dead horse. All right, so gross profit margin, here's the formula. Sales minus expenses divided by sales, right? And that gives you your gross profit margin. The operating margin is operating profit divided by net sales. And then net profit margin is your net profit divided by sales, right? So you see how sales is like kind of like the common denominator here. And yeah, so that just gives you a better picture of how profitable a company might be, as opposed to just the whole number, because the whole number could be a little misleading. Now we have return on equity. So now this type of ratio indicates how effectively the shareholders' money is used by the company. So remember, equity is assets minus liabilities, right? So, this is kind of studying like, okay, for the money that is left over for investors, what is going on with it? So you have return on equity, which is net income divided by equity. And the higher the ROE, that means the better is the return to its investors. Then you have return on assets. The return on assets formula ratio indicates how effectively the company is using its assets to make a profit. The higher return, the better is the company in effectively using its assets. Now we have market value ratios. And I think this is also a very important section, right? Under these types of ratios, it really just helps us evaluate if a company, for example, is trading at a good valuation. Is the valuation too high? Is the valuation low? Is it overvalued? Is it undervalued, etc.? So the first one they have is the book value per share. The book value per share ratio is compared with the market value to determine if it's costly or cheap. I want to get you guys a nice definition for book value. And I know we covered this book value earlier on in one of the earlier presentations, but I just want to find this again for you. All right, cool. So the book value is the value of all the company's assets minus its liabilities, right? So you might have a company, and then so sometimes, which is like what value investors are looking for, they want to see a book value that is greater than the market cap. So for example, right, let's just say you have a let's say you have like a real estate investment company, right? Let's say the company is trading at a market cap of like $50 billion, right? Let's just make that assumption. Let's say you go and look at the book and the value of its real estate holdings, right? If you do the book value, right, you might say like, oh wow, this company on its books, even though it's trading at $50 billion, they have like $100 billion in real estate. And then let's just say they only have like $20 billion in like debt or something like that, or debt and like long-term liabilities. Now you have like a book value of 80 billion, right? So now the company is trading at 50 billion, but it's really worth 80 billion on paper. And so that company, you would say, is trading at a discount to its book. Does that kind of make sense? Right, where you're looking to see like if the company has more assets than its actual market cap.
Yes.
Okay, cool. So that's the book value. And you're doing shareholders equity divided by total share outstanding. Remember, right? Shareholders equity is assets minus liabilities. So you do the assets minus liabilities divided by the total shares outstanding, and if that's greater than the market cap, then you would say that this company is undervalued. Dividend yield ratio. Dividend yield ratio shows the return on investment if the amount is invested at the current market price. So pretty much, so sometimes these ratios are better than looking at just the whole dollar amount, right? So you could have two companies that's paying $1 per share in dividends, but based on its current stock price, right? One company might have just like right here, right? A dividend, a yield that is like 5%. And then another company, even though they're paying $1 per share, is giving you a yield of like 1%, And so, rather than looking at like the whole dollar amount of what the dividend is being paid, the dividend yield just kind of gives you a better idea of what you're getting from this dividend. Does that kind of make sense? Okay.
Yeah.
All right. I guess. Okay. Thanks. Yeah. If you guys, if something doesn't make sense, just feel free to drop a question in the chat or ask out loud. Okay. Market cap. So the market cap is the value of a stock in the market. So if you come here, pretty much the market cap is the total shares outstanding times the current market price, right? So this company has 400 million shares outstanding, and they have a market cap of 10. I mean, it's gonna be a stock price of 10. So you would do that 400 times the 10, and now you see they have an almost $4 billion market cap. I don't know why it's a little under, but yeah, that's the market cap. The shares outstanding times the price of the stock, and that's just really much what investors or the market is valuing the company at, right? So there's the market cap, and then there's what a company is actually valued at by when you're looking at its book. And then so for value investors are looking to say like, hey, can I find a company who on their books, they are worth more than what they are worth in the market? Does that make sense for you, Raz?
Yes, that makes a lot of sense.
Okay, perfect. Good question. And yeah, guys, feel free to jump in and ask questions. And I'm looking at the time now. I'm feeling like we're gonna have to do the actual stock screener next week. Just because this is taking up a lot of time. But once again, this is a very important topic, and you can't use the stock screener efficiently unless you understand these things. Then there's earnings per share. We're all very familiar with the earnings per share, right? It's pretty much indicates the amount of income earned for each share outstanding. So earnings for the period is the net income divided by the number of shares outstanding, and now that gives you the PE ratio. Excuse me, no, I'm fumbling my words. Net income divided by number of shares outstanding gives you the earnings per share. The PE ratio is the earnings per share. Is the share price divided by earnings per share. So the price to earnings ratio is calculated by divided by the market price by the earnings per share. This ratio is compared with other companies in the same industry to see if the market price of the company is overvalued or undervalued. So once again, right, a lot of these ratios, there is no like set, like, hey, I need a company that is a PE of 20 or a PE of 10 or a PE of 50. It's more so, what is the industry average? And then can I find a company with a lower PE? On the flip side, if you're looking at high growth companies, you actually might want a company with a higher PE. So just putting that out there, because usually like higher PE companies means that they have higher expectations for growth. And then if they can meet those expectations for growth, that means the stock is going to perform. So I just want to say that a high PE doesn't necessarily mean it's a bad thing. A high PE really just means that the company has a higher expectation for growth. But if they can meet those expectations, then it's fine. There's even sometimes companies that they have a high PE and they outperform their PE. And you can almost say that even though they have a high PE, because they have a higher growth rate, then it's almost an undervalued situation. So for example, a company might have a PE of 100, right? You might say, oh my God, that is an outrageous PE. But if the company is literally growing its sales and profits at a rate of like 250% a year, then that 100 PE is not only justified, but they're completely outperforming it. So just to keep that in mind as rule of thumb. And then this is it. I guess we do have some time to go through the stock screener because we have another 30 minutes. But before we get into the stock screener, how are you guys feeling about this topic? I know this is a lot to digest and maybe a lot of new material here.
Hey, Jeff, are you ever going to do like just a live, like quick through of how you delve into this information and how you go about searching for it?
Yes. So last week, so this is a great question you're asking, Alex. So last week, the group decided, whoever was on that call last week, decided they want to meet up every Wednesday just to do just that, right? So on Wednesday evenings at 7 p.m., we're meeting just to strictly go through ideas, look at companies together, look what's happening in the market together. And yeah, so
That's great. Okay.
On the Saturdays, we're doing this, which is like pure curriculum, but on Wednesday evenings, we're going to be doing just that. So yeah, you guys should have gotten calendar invites for Wednesday evenings at 7 p.m. If you didn't, let me know, but you should have gotten it. And then also, before each session, we drop it in the Telegram anyway. So yeah, every Wednesday, we're going to be doing just that. And we did it last Wednesday. We had a phenomenal session last Wednesday, by the way. I think we covered some great things and yeah.
Are you guys going to record those?
Yes, I didn't record the last week one by accident, but we're going to record those and make sure we put them up on YouTube.
That's great. Thanks.
Yep. Anyone else before we hop into the stock screener? Anyone else have any questions on this topic?
One more thing. From what I'm hearing on the news, there's a lot of companies right now with the highest PE ratios that in history, right? It's like really crazy off the chart stuff right now, right?
Absolutely. Yeah, there's a lot of companies with very high PE ratios, very high price to sales ratios. Yeah.
Is that a telling sign of anything, or is that just a telling sign of just the company or maybe the sector?
It is a telling sign. It's a telling sign that companies are trading at extremely high valuations. And that also means that being able to do research and investigating these companies are even more crucial, right? Because if a company has a high PE or a high price to sales ratio, and I feel like they didn't cover price to sales ratio in here. So the price to sales ratio kind of just tells, and I just want to cover this one as well because it's very important. The price to sales ratio covers, it tells us, how could I say this? Let me get a nice stuff. And I know these things in my brain, but sometimes just saying it out loud is I can't find the words. Let me find a nice definition. Price to sales ratio. Okay, the price to sales ratio compares a company's stock price to its revenues. It's an indicator of the value that the financial markets have placed on each dollar of companies' sales or revenue. So it pretty much says the price to sales ratio shows us how much investors are willing to pay per dollar of sales for each stock. And pretty much, you're dividing the stock price by the underlying company sales. A low ratio could imply that the stock is undervalued, while a high ratio could just indicate that the stock is overvalued. On the downside, the price to sales ratio is that it doesn't take into account whether the company makes any earnings or whether it will ever make earnings. So especially for tech companies, price to sales ratio is very important, right? In the tech space, because a lot of those companies aren't profitable, or even if they are a little bit profitable, the PE could be misleading because these companies need to get to scale. Scale meaning like, going from like 100,000 users to like, 50 million users, right? Once they can really get to scale, they can really, get some really nice profits. I'm just saying, like, even as they're scaling, even if they're a little bit profitable, they still have a lot more room to grow in terms of profitability. But you'll see, right? Like, you might hear something like, hey, this tech company is trading at 10 times sales or 20 times sales or 30 times sales, right? And you kind of just once again want to look at what is the industry average for price to sales, and then is my company trading at a lower price to sales than the other companies in the industry? It's a very important ratio because a lot of tech companies aren't profitable, or a lot of rapidly growing companies may not necessarily be profitable, and so you're kind of basing its valuation on its price to sales ratio. So I just want to put that out there. I lost my train of thought. Alex, you just asked a question. What was the question you were asking again? I know I went on a tangent.
I'll lose it pretty quick too. So we'll have to go back on the replay for that one.
Okay. Oh, I think
I think I was asking like, is it a certain indicator for certain things?
Yeah.
All this information.
Yeah. No, it really just indicates that the market is overvalued, and that also just feels like it just really tells you that whatever stocks you're going to be picking, you just really got to make sure that a company can live up to its hype. A company can, like, once again, if a company has a high PE ratio, it's okay if they have very high growth rates, but if they have low growth rates, like, if they're growing at 20% a year and they have a PE of 70, that company is like way overvalued, and that's maybe not a company you really want to touch. In this
So like with these growth stocks, like you're talking about, what would be a good ratio if something had a crazy insane? How would we find the right ratio between the two?
Yeah, I would say the first thing is look at the industry average and then say, is this ratio lower than the industry average? So if the ratio is lower than the industry average, then one, that's a good rule of thumb. Then the second thing is to look at the growth rates or the expected growth rates for the company. If the company is expected to grow at 30% for the next 5 years and it has a PE of 15, then then that company would say is undervalued in respects to its growth.
Can we find growth rates on that CS that website you just showed us?
Yep.
Okay.
You can. So you see on the side right here, They have like, growth rates, profitability, valuation. So they have all that actually.
Gotcha.
And then secondly, you also have that on here in the screener. So you see earnings per share growth the next 5 years, sales growth past 5 years, sales growth quarter over quarter, earnings per share growth next year. I wish they gave us the expected sales growth over the next 5 years. But they don't give us that. But but you do get growth rates in the stock screener on FinViz. So yeah. But yeah, just back to your overall question though, right? Like, when the whole market is just at like, historically high record highs for valuations, all it means is just that you just got to be better at picking quality companies at decent valuations. That's just really what that means, or it might just mean that, and I think it's sometimes okay to sit on the sidelines. If you can't find things that meet your criteria as an investor, and whatever the case might be, then it's okay to say, like, I'm not investing in anything right now, or I'm not looking for opportunities in the stock market. Maybe you're looking at cryptos, maybe you're looking at NFTs, maybe you're looking at real estate, maybe you're looking at just starting an actual real business or investing in a small business, right? There's just all kind of opportunities out there in the world. I just want to put that out there, so it's okay to say that, hey, valuations are so crazy, I'm not investing in the stock market.
That's great advice.
Mm-hmm. Yep. So before we move on to the stock screener, anyone else have any questions or thoughts on this stuff? Nope. Okay. All right. So with the stock screener, I want to say a couple things, right? Someone has something to say?
Yeah, I was just gonna add a comment, not really a question, but this topic is something that I kind of struggle with, even though,
Mm-hmm.
it's just, like you were saying, well, if you're looking at a tech company, this may be good, but if you're looking like maybe at an industrial, maybe that's okay. So maybe during your Wednesday call, it would be helpful for us to kind of dig deeper into some examples, to kind of put into practice looking at some of these ratios, because I started looking at some of the ratios, but because there's so many and I'm researching it, I sometimes couldn't tell like if that was a good thing or a bad thing with the company. Somebody said, "Oh, this is a good company to look into," but then I pulled up FinViz and there were things that I felt were alarming about that company based on the data. But I don't know, maybe it was okay and normal for that particular industry. So that's my thought.
Yes, and and what you're getting at is that all these things are relative. Nothing is absolute, and yeah, we could definitely, and if you have some examples that you want to look at together, just make note of them, and if you want, you could send them to me, and so if I can review it before Wednesday's session, then I might have some, like, tangible feedback and some tangible examples to go through, and I'll make sure I research some stuff for you guys. Just for some examples. So thank you for that, Rashad. If you want to send me those companies on the side, I'll start, looking into them so we could prep for Wednesday.
Okay, that sounds good. Thank you.
Yeah, and then other thing, just to like add on to that, Rasharda, and just for all you guys, I think this topic is not necessarily an easy one. I know I may make it look easy, but I'm a person with almost 10-15 years of, like, doing this kind of research, this kind of fundamental research. I did accounting in college, and I still do accounting, clearly, like, so I'm just saying, like, if you guys want to do some one-on-ones to really go through this as well, like, just make sure you're booking time on my calendar, and I will reshare the mentoring link in the group chat, because I think it's not an easy topic, and just getting that special one-to-one attention might make it just a little easier for you guys to start grasping it, because it just takes work and practice. But once you get comfortable with it, you'll see it's easy, but when you're seeing it for the first time, it's a little complex. So with that being said, I want to say, when you're using a stock screener, right, a stock screener, it's not going to give you that one company you're looking for, right? So when you're looking for using a stock screener, you want to start with, what is your goal? What are you looking for, right? Are you looking for a high growth company? Are you looking for an undervalued company? Are you looking for an industry leader? You know, you got to kind of have like an objective in mind, because a stock screen is going to give you 30 companies, 50 companies, 100 companies to look at, and you still got to go through each individual company to find the actual company or companies you want to invest in, right? So I just want you guys to just operate from that mindset. So with that being said, let's just maybe go through some examples. I know in my case, right, I might be looking, and I'm going to go through what I did on Wednesday. I was showing the group like how I'm trying to find companies outside of technology, right? And I'm looking at, I'll come here and look at like, the 3-month relative performance, half-year relative performance, 1-year performance, 1-month performance. The 1-day relative performance could just be very misleading, because that just kind of just shows you, what happened that day, right? But these ones kind of just tell you like, who has strength in the intermediate term, right? And it's energy, it's consumer defensive, it's basic materials, utilities, real estate, financials, industrials. And you're seeing like, tech is at the bottom, right? Maybe because yesterday we actually had an update in the NASDAQ. Now these numbers are a little skewed, but that's okay. So, right, I might come here and let's say I want to look at basic materials. I'll go and click basic materials. And then I'm going to see like, who's strong in this sector or who looks interesting to me in this sector, right? So one of the things that I've been looking into is, actually, let's not do basic materials. Let's just use the example of supply chain. Because I know we've all been hearing about supply chain issues. And for me, whenever you hear that there's kind of issues that's disrupting like the global economy, that also means that whatever companies are in that space that's doing it well, their stock is going to perform well, and they're going to have sales and profit margin because they're solving like critical problems like the global economy or the local economy, or I should say maybe domestic, because local is like New York State or New York City. Domestic means like the United States as a whole country. So one space that I've been looking at is is it under industrials actually? Yes. So some of the things I'm looking at is actually marine shipping, because that's supply chain, industrial distribution, that's supply chain, integrated freight and logistics. So let's just go and click marine shipping. Right. I might come here, and the first thing that I'm doing is just getting a feel for, like, you see I already have, so they have these settings, right, where you can kind of pick what's important to you. So for me, I have sales growth, earnings per share growth, sales quarter over quarter, dividend yields, operating margin. We could put in net profit margin. That could be relevant. Let's throw in quick ratio as well. We could even throw, because these companies probably carry debt, total debt to equity. And the first thing that I might do, and you see it's only 31 companies in this segment, right? So I might just see, okay, who is growing the most, right? In this space where there's so much issues around shipping and people getting stuff on time, whatever the case might be, whoever is doing this well and is really has high sales growth is probably going to be industry leader. Or it's not an industry leader, but they're solving some kind of problem because people are paying them money, right? And look at this industry. Almost every company is experiencing quarter over quarter sales growth, right? So it's one thing for a company to have year over year sales growth, right? But when you're having quarter over quarter sales growth, that means like, yeah, each quarter we're growing, right? And that means there's demand for their products for whatever the case might be. And then you're seeing these big numbers, 300%, 250%, 100%. Like, this is actually really good quarter over quarter sales growth. So now we're seeing, okay, there's sales are strong in this sector. Now I might come here and say, okay, who has the highest operating margin, right? So peep this, right? When you look at the sales quarter over quarter, when you're looking at market cap, right, it's actually some of the smallest companies in the space that's having super high sales growth. Granted, note this, right? This Zim is a $7 billion company and it's having 209% sales growth. There must be something going on with this company that they're growing so fast. And they also have a high profit margin, operating margin, 48%. So now let's just go back to this. Right. So one of the largest companies in the space has one of the highest quarter-over-quarter sales growth and has one of the highest operating margins. And they probably have one of the highest profit margins. Interesting. Check this out. See how this company, I know we probably spoke about this earlier in the program, right? A company can have, how does a company go from 51% operating margin where now when they're including more expenses, their profit margin is higher? So remember I was telling you guys about financial trickery, right? So that's something to investigate, right? That doesn't make sense, right? Your operating margin should typically be higher than your profit margin, right? So maybe there's something going on in their books that is inflating profits. So I just want to put that out there, because I know we were talking about that last week in the financial statements, how companies can inflate profits and why operating margin is actually a good metric to look at for just pure, this company's running their operation. Is it a profitable operation? Is it generating cash flow? And what is its margin?
Hey, Jeff, so in this instance, what would be your first thing to do to dig in a little deeper?
The first thing to do is to go to the company and to go to their, you got to go to their financial statements. So let's go and see SEC filings. Quarterly filings. 2021. Okay, this is a foreign issuer. Okay. I'm going to be honest. I do not remember what is the quarterly report for a. I know it's the. I know what the annual report is. Let's see annual. It's 20F. I forgot what's the quarterly report for them. For U.S. companies, it's a 10K. Well, the first thing you want to do is just go and look at their financial statements. Let's see, maybe it's this.
I saw some lower down that said financial statements on the bottom, I think.
Yes. Let me go back up to the top. Maybe I clicked the wrong thing. Oh, yes. Let's see. You know what? So this is maybe last year's, and I'm sure this operating margin and profit margin stuff is reflective of maybe like the latest quarter. Let me go back to FinViz. Let's see. So they have this over here. Okay, right. So we see they have for the trailing 12 months, so it's not for the full year, but the trailing 12 months, they have an operating income of 265 million. And now they have, is it million or billion? Let me see. Okay, yep, it's in the millions. So the operating income of 265 million, while they have a net income of 348 million. And so we're seeing they have interest income of 49 million. We have to look at their quarterly report to see what's going on, right? Because once again, this is gross profit is one level of profitability. Operating income is another level of profitability. And you see as you have your profitability, and then you have expenses, right? Then you have your profitability, then you have expenses. But in this net income space, like because of taxes, because of interest income, so they have a term EBITDA, right? Earnings before income, taxes, depreciation, and amortization. And in those line items, right, things can be inflated. So we have to look into that. But this is a consolidated like income statement. This is not like their full income statement. So I gotta find that. So this isn't a good example, only because it's a foreign company, and I do not remember what is the quarterly report for a foreign company. Let's just Google it. Quarterly filing for foreign issuers. Okay, it's a form 6K. So let's see if we can find it real quick. I don't want to waste too much time on this just because time is limited. Let's see.
Yeah, we can do this on Wednesday. It's all good.
Okay, yeah, I might have to just find it on my own, because the 6K is not just their quarterly report. I'm gonna have to go through all of their 6Ks to actually find a quarterly report. But that's just an example of how you see, right? Like, as you're going down the balance sheet, that doesn't add up, right? And you just got to investigate why that happened. All right, let's go back though. But that's what you do in that situation. You got to go and investigate the company, right? We can look at the profit margins. Who has the highest profit margins? They have the highest.
Hey, Jeffrey, I have a quick question.
Mm-hmm.
So as you're going through and you're looking at these, do you place any significance on the country that the companies are in? Like, do you try to stick to U.S. companies, or does that not really factor into it for you?
I want to say that question is relative. In the case of looking at global shippers, I am open to looking at any company from any country except for China. And actually, that's just kind of my rule of thumb in general. I'm open to looking at any company from any country except for China. Just because China has its issue where I'm sure you guys remember, right? Like the government is like kidnapping their billionaires. The government is waking up on any given day and saying that, hey, for whatever reason, we just want to shut this company down, or the government is just saying that, hey, we've been awarding this company contracts for X number of years, but we just woke up today and decided that we want to give another company these contracts, So China, the way they do business over there is a little tricky, and it's very like politically driven. So that's why I try to stay away from China. But I'm comfortable with European countries just because also European countries have similar accounting standards and similar just financial standards to the US, and just in terms of like how they operating in free markets, etc. And then also for European countries, getting data isn't hard compared to maybe like Latin American countries, right? Just because it's in a completely different language, like if I go to like the Greek website or the Israeli website, all these websites are going to be in English. You go look at like a Latin American country, they're all going to be in Spanish. And that sometimes just makes things tough because myself, I can't read Spanish, so I can't get good data. So personally, I'm comfortable with international plays. I might just also just do a little extra homework around the country and the state of the economy, but yeah, does that answer your question?
Yeah, no, it answers my question completely. Thank you.
Yeah, cool. So this right here, what I'm doing is kind of just like one tactic for finding companies, right? I'm going to a specific industry just because it's not when you go to a specific industry, it's not necessarily a lot of companies. And then you kind of just go through the metrics, right? And see who has the best metrics and then pick companies based on that. But you still just got to go through, not every single company, but what I would do is I'm going to go through the top companies, right? I'm going to look at who has the top operating margins, who has the top sales growth. And then also, I'm also looking at who has the largest market cap. For me, when I find like a company like this, right, who is the largest market cap, but then also has like one of the highest sales growth and highest operating margins, then I might want to just invest there, right? Because it's a real thing, right? When a company is like, in this case, a $7 billion company versus a $500 million company, this $7 billion company has way more resources to eat up market share, you know? And unless this $500 million company has something innovative or whatever that they're doing that the bigger companies can't do, you know, like the bigger company is going to win every time. And that's maybe kind of just rule of thumb. I mean, you still got to investigate the companies and see what they have going on, because you cannot make that judgment by just looking at the numbers. You got to look at what their services are, what markets they're operating in, and how they're doing things. But yeah, so this is just one tactic for stock screeners, right? Just coming to an industry, you know, you come and click, and just to bring you through the process, you pick your industry, you click the settings thing, and you got to click custom, right? So normally when you come to FinViz, it's gonna default to charts when you pick an industry. But you got to just come and click custom, and now you got to pick the criteria that you feel is important to you. So I mean, these are the criterias that are important to me, you know. So this is what I'm looking at. And then I'm just trying to see like, okay, who got the best numbers, and then I'm starting from there by going through them one by one. So that's one tactic. Now let's just say we're starting completely from scratch. Say, you know, hey, I want to find, you know, the best companies in tech, right, or the best growth companies in tech, right? So now I might come here. You can filter out by sector. I'll pick technology. Now some of those metrics might be, okay, who has high sales growth quarter over quarter? Then I might come here and say, who has, so operating margin is important for me, you know, so I might say, let's just say who has just a positive operating margin. Then now let's say, what's maybe some other quick ratio over 2. So they're flush with cash. Now we have 60 companies, right? And now I'm back here playing the same game, right? I'm gonna go and just click the sales growth quarter over quarter, who has the highest sales growth. And as I said, I'm staying away from Chinese companies, because China, you know, a company could be a darling today, and the government wakes up tomorrow and they're giving someone else the contracts. And that's another thing too with the way business is done in China, right? The government just kind of gets to select like, hey, you know, you are going to be responsible for this market or this industry, you know, where in the US, it's a free and open market, right? So everyone can go out there and compete, and whoever gets to dominate a market is dominating because they may be the best, or they have the best resources, or whatever the case might be, right? So the free market determines who is the industry leader, where in China, the government determines who is the industry leader. And for me, that makes me uncomfortable as an investor, because you could wake up any day and they just decide that they don't want your company to be that anymore. So yeah, I'm looking at sales ratio, right? This is interesting, right? There's this company with a quick ratio of 16. That means for every dollar they have in current liabilities, they have $16 in cash. This company is flush with cash, right? I might say like, what's going on in this company? Now I might come and look at their price to sales ratio, right? And just seeing what's that like. And this is kind of how I'm doing things. Another way that I'm doing things too is also just looking at the charts and seeing who has nice looking charts, right? Like, oh, interesting. Wow, Shopify sold off a lot. That's crazy. But like, look at this SITM. This looks like this is holding up nice and strong. I mean, the NASDAQ has been selling off, so these things are going down, right? But overall, the chart is in an uptrend. So that's another thing, right? If I'm looking to go long, I'm looking for companies that their charts are in an uptrend. Like this looks good, you know. The NASDAQ has been selling off, but this is actually really holding pretty steadily. Another thing too, I might say, hey, you know, I don't want small companies. I want to see the large companies, right? So maybe I might come here and say, hey, I only want to see the tech companies that fit these criteria that has market cap over 10 billion, right? So now you're seeing, once again, I'll come here, what's the sales growth quarter over quarter, right? And I want to say, right, this is not an easy thing to do, right? For a company to be like a $10 billion company, to be having like 96% sales growth, that's not easy at all. But they're a solar company, and that makes sense. This is a funny name, AppLovin Corporation. But yeah, so this is some of the tactics, right? So you guys may make this like a rule of thumb, right? If I'm looking for high growth companies, right? You're looking for high sales growth quarter over quarter. You're looking for a quick ratio. I mean, I like to use a quick ratio over 2 or more. I like to look at operating margins, but there's so much to look at, and this maybe just goes back to, really understanding the different financial ratios, and then you can pick like, hey, what is important, or also understanding what's important for an industry, right? In tech, price to sales and sales growth and revenue growth is everything, right? A company can be losing money for years. Amazon is a great example of that. Amazon is one of the largest companies in the world. They only became profitable like 5 or 6 years ago. So even while, let's just pull up Amazon's chart just to show you, like, the growth while they were an unprofitable company, but they had phenomenal sales growth, right? That's weekly. You got to pull up the monthly. All this time, all this growth, never profitable. This is phenomenal growth. They were never profitable. So you also got to understand for your industry what metrics are important, and then you want to filter for those metrics on the screener. Does that make sense for you guys?
Yes.
Okay, cool. Okay, Vanessa, thank you. We'll see you on Wednesday. So yes, well, let's go back. Now let's say we're looking for undervalued companies, right? I know a lot of people are talking about industrials a lot. So let's click all again. So now let's come to industrials, right? So, with industrials, you maybe aren't expecting high sales growth, but you might want to come here, and with industrials, you might more so find undervalued situations, like pure undervalued situations. So let's see, price to book. Price to book. Let's see. Not price to book. Let's see. Do they have book value per share? Let me so these are actually all companies that maybe might be deemed undervalued, because like their price to book is less than 1. So that means that they have more in assets than they have a market cap, right? So that's one way to find like some undervalued companies, right? And you see in industrials, like you literally found 80 companies. If you went to tech, you might find 0 companies that are like that, or very few. Let's open up filters. Whoops. All right, so let's not even look at price to book. Let's say, let's first look up the average PE for the industrials industry. You know what? They don't just have industrials. You see, this would be considered industrials. This would be considered industrials. So you have these broken down into 2 separate categories. So let's just click capital goods and see what that is. Valuation. I want to see the So the average PE for capital goods is 31. let's see what's the other one. The transportation is also in industrials. Wow, this is really high. That's crazy. Okay, so let's just start with this, right? Or let's maybe look at basic materials. So this is similar to FinViz, right? So 31 is for basic materials. We can go to the basic materials industry and look at that on FinViz. The average PE is 31, right? So maybe we want to say companies with PE under 40, just to give a little wiggle room, right? So we have 147 companies. Or if we really just want to find, you could do under 35. See what's 30, see under 25. You still get a lot of companies. Now we might want to say what companies have a positive operating margin, just to make sure that they're, especially for industrials, you want to make sure that they're generating, you know, their operation is a profitable operation. We want to maybe see a low, let's just say under 1. You know, less than 1 debt to equity. Maybe we want to say that they have some cash on hand. Let's just say over 1. Let's click over 2. All right, so now we're down to 25 companies in the basic material space, right? So from like a valuation standpoint, this might be cream of the crop. You know, all these companies have a PE less than the industry average. All these companies have a positive operating margin. All these companies have, you know, for every dollar in current liabilities, they have $2 in cash. So that's good. They have cash on hand. And then they have little debt to equity. But you know what? Maybe let's remove this one because, yeah, you see, even removing that. Okay, so that's good. And then we have dividend paying companies here. So almost all these companies are paying dividends, right? So now I might literally just come here and let's see, operating margin. Right, we might look for the high operating margin companies. And you're seeing the companies that are having the highest operating margins are actually some of the biggest companies in the space. So that's just interesting to note. Let's see who has good sales growth. Right, some of the largest companies in the space is having the highest sales growth. So that's interesting as well. Let's see who's paying the best dividends. You know, and then I might look at these things like from this perspective, and then I'll literally just start going through these companies one by one. So I actually own Southern Copper. I'm a little bit bullish on copper, but that's just me. And yeah, I'll start going through these companies one by one and just seeing, what's good and who has a good fundamentally sound business that's going to really grow and capitalize on whatever trends are going on. And yeah, so, this is kind of how you got to use a stock screener. And I know this might be a lot to digest in this one setting, but I just want to open up to like questions or thoughts on like the stock screener. Are you guys maybe feeling that this is a little bit comfortable to use, or if anyone wants to share some thoughts?
It's going to get comfortable, that's for sure.
Yeah. And I know it's the first time seeing it, and it just takes practice. And on the Wednesday sessions, I'll definitely make sure, we do something with the stock screener, every Wednesday, just to get you guys more comfortable.
Do you pay for is this totally free, or do you pay for like a certain subscription or anything for this?
So I actually do pay for this, but they do have a free tier. But I pay for it because the paid version just gives you a few extra features, but I don't think it's necessary for you guys to pay for it. Also, the paid version allows you to export lists, right? So when you have the free version, you can't export, but I like that I can just come here, click export. And that's something that I haven't done for you guys yet, but I actually paid for it strictly for this export feature so I could start doing screens for you guys. And then just like, when I go and do screens, I could just go and send you guys to companies, and this is nice too, right? When I do the export, it actually exports it with all the criteria that I have in custom. Whoops, I didn't mean to click that. I'm curious if you do. I did have an export for charts. No, they don't have an export for charts. Let me see overview. Yeah, so when you do the export on here, but you guys don't need to pay for the you don't need to be paying for the for this. I paid for it because I have my own uses for it, and that's that's me personally, but it's free to use.
I've played with it a little bit. I remember last time and the other time we were getting together that you showed FinViz, so I played with it a little bit. I've heard of Benzinga too as a good screener.
I never used it. Let's check it out.
Yeah, supposedly Benzinga Pro. I believe theirs is you have to pay for theirs.
Oh, okay, you gotta pay for it.
Yeah, I think you have to pay for theirs. I don't think they have a free option like FinViz. But from what I hear, FinViz is definitely the best one for free.
Yeah, I think so too. FinViz is definitely the best one for free. So yeah, it's just and as I was saying at the beginning of this call, you really need to have a good understanding of financial ratios to use a stock screener well, right? Because then if you don't have a good understanding of it, then you can't screen properly. And then they have some other metrics that we're not talking about, right? But then they have insider transactions, right? So this, you might see in a particular industry or just in general, right? What companies have, the executives in the company and the board members are buying up the stock. You have institutional transactions, right? What companies in a particular industry or individual company are like hedge funds and asset managers and other institutional investors buying up the stock. Just because institutional investors have to report what they buy, you could capture this data, right? Then they have, for you guys who are interested in technical trading, right? You could literally screen for technical patterns. Let me just click technical just to show all the technical stuff. And I know we didn't cover technical stuff, but it's still here, right? You can come here. Let's just click charts. You come here and see who has a strong channel up, and that's like a technical pattern. Like me, I like this kind of technical pattern, or who has, let's see, it just says trend line, resistance strong. Let's see. Okay. So, who has an uptrend, right? And who's in an uptrend, right? And then that they are at the resistance level on the uptrend, right? This is the resistance level, this is support, right? And that's a good look. Who is, so let's see, multiple tops. So I'm just saying, right, you could come here and screen for like all kind of things. You can see who is, let me just click, get out of this, who is, making new highs. So this is actually good for tech, right? You might say tech has been getting sold off. And let's say you're a technical trader, but you want to find the strongest tech companies. Descriptive, you might go to technology. Wow, like only 5 tech companies are making new highs. All right. And then you might say, hey, if these companies are making new highs, I actually own HPE. So that's great to know. You might say, okay, like what's going on in this company that only these 5 companies are making new highs, because tech has been getting destroyed. Let's go to technical. So I'm just showing you guys all this, and then you can also screen from moving averages, right? Who's trading below or above their moving averages, 50-day, 200-day. Who had a gap up, from the previous day, etc. Right? So I'm just putting out there that they even have a bunch of technical screeners that you can combine with the fundamentals. You can combine it with the descriptive stuff. If people want to play IPOs, right? You can see, who IPO'd last week, who IPO'd whatever. Like, whoops, didn't mean to click that. So just want to show you guys that, you can screen for more than just, did I close it? No. Yeah, you can screen for more than just,
How did you do the ones for the gap ups?
So you gotta come to technical. Let me just.
Okay, I see the gaps now. Okay, I see.
Yeah. And then you can click this all, and then you can see everything, but then you get this strict technical. They have gap, change from open, chain. I mean, change from open, like this might be more relevant for like day traders, or short-term swing traders, some of these things. You can see, hey, who in the industry, like let's just say like, once again, tech is down. So you might go to technology. Where do we go? Boom. Let's not do new highs. But let's just say, who was up for the day? So you might do this on like the next 350 point down day on the NASDAQ. Today it's showing you 341 companies, but when we have like a 2% or 3% down day on the NASDAQ, you might see like only 20 companies, right? And if you only see those 20 companies, then those companies are worth investigating, because there must be something special going on in those companies that people are buying those companies on down days. So this is sometimes the way you got to like think through these things. So I know this was a lot, and maybe we could stop here. And maybe I just want to give you guys a moment to ask any questions or any thoughts. Thanks, Mariah. Thanks for the support as always. I know this session went a lot longer than normal. But anyone have any questions or thoughts? Nope. Okay.
No, thank you for going into so much depth on this topic. Think you did a good job.
Yeah, thank you. I try my best. But I feel like it's practice, and every Wednesday I'll make sure we're going through the stock screener, and you guys should be going through it too and coming back with questions. And I think the more we do this as a group, the more comfortable you all will get.
I had one more comment, not that you have to address it now, but maybe for Wednesday. And maybe you touched on it and I just missed it, but when we talk about insiders or even institutional investors and, just things to look for in that, I think that it would be, I want to hear your thoughts on that maybe Wednesday.
Yeah, we can answer it right now, real quick. So with that, I think once again, like I said at the beginning of this, right, you got to ask yourself, when you're using the stock screener, what is your goal? So sometimes I'm doing that, right? I want to see what companies are institutions buying up, and I think that's a fair question, right? So I might come here and just say like, hey, like what companies is institutional transactions up over 50%. That means like institutions are like hungry for this stock, and even though all these charts are down, I would still go through each single one of them, just because if institutions are buying these things up, there must be something going on in these companies. So yeah, I think you just got to ask yourself, like, what is your goal, and if that's what you want, you just got to set that metric and go through them. Does that answer your question, Rashada? Are you on mute, Rashada? Oh, I think you're on mute if you were saying something. Okay. Well, yeah. Anybody else have any questions or thoughts? Nope. Okay. So I'll see you guys Wednesday, and I will also drop the mentoring link in the Telegram, and I'll see you guys Wednesday.
Appreciate you, Jeff. Thanks a lot.
Yes. Have a great weekend. Speak
Thank
soon.
you. Bye-bye.
You as well.
Yep.
Take care.
Yep. Bye.